Good morning, everybody. Welcome to Town Insurance with Mary Carter Snido and Travis Law. We're going to go ahead and get started. Mary is the coordinator between Town Insurance and our mortgage partners, and so we're happy to have her on here. And we've also got Travis, and Travis is one of our insurance agents. So I am actually going to, I've moved it to overview. I'm going to mute myself and just turn it over to you guys. Thanks so much for being here.
Thank you, Sarah. Travis,
Yes,
I'll let
thank
you.
Yep. So I'm Travis Law, as everybody, as Sarah had mentioned, and thank you for having us. Mary Carter and I are obviously with Town Insurance, and so we wanted to give you a brief overview of what Town Insurance does as a company, and some resources that we think may be valuable to you as realtors. So to start off with, Town Insurance is headquartered in Virginia Beach, of course. We have offices across the state of Virginia, North Carolina, and we just entered South Carolina last year. So we're based in 3 different states. We are fortunate to be one of the top 48 largest insurance brokers in the United States, which with a footprint of being in 3 states is pretty impressive, I believe. We're highly saturated in our markets, which says a lot about our company. We offer different types of insurance, including personal insurance, home, auto, umbrella, boat, flood insurance, builder's risk coverage. We also have a very large commercial insurance department, which they can do anything from business owners policies, errors and omissions, workers' compensation, etc. Our benefits department is also pretty large, and that provides health benefits primarily for commercial clients, but we also provide that for personal clients. And typically you'll find that in that division that we will also offer life insurance, long-term disability insurance, etc. So we're pretty much a one-stop shop. And in Virginia, we write with about 30 different carriers. We have access to, as a company, to over 200 different companies. But I would say our core, home, auto, umbrella, boat, flood, our core group of carriers is right around 30. That's pretty impressive for an independent agency. A lot of companies might offer 5, 10, maybe your larger agencies might be able to access up to 15. So to have 30 carriers means that we're able to capture a very large market, which allows us to be more competitive, which is good. We do have direct access to all of the high net worth insurance carriers, which is also somewhat unique for an insurance agency. And a list of those carriers is included. And one thing that Town sets us apart a little bit from some of our competition is we only write with A-rated AM Best carriers. So what does that mean? It basically is that our only AM is the globally recognized rating company that rates the financial stability of insurance companies and their capacity to take catastrophic losses. So you feel comfortable being written with an A-rated carrier by AM Best. Not all companies are AM Best rated. Some do not have the financial capacity to achieve that, which is more of a risk, so to speak. So that is one thing that does set us apart. We also have in-house claim specialists, which is wonderful. Typically claims do go very well, but sometimes you need somebody with almost a legal background to dissect a claim and to and perhaps fight a claim on behalf of our clients. And we do have that in-house. And I can personally say that just last year alone, by having that liaison within our company, which most companies do not have this, I personally had clients that had over 6 figures in claims paid out that wouldn't have otherwise. So that's a very nice asset for our clients. And we do not just write in North Carolina, Virginia, and South Carolina. We write in the lower 48. I have clients all over the country, from California to New York to Florida, Texas, all over. So we can do a lot. So let's talk about what is in our market. So what's happening? So in the early 2000s, a lot of companies changed their coastal appetite. You probably saw in wind deductibles, storm deductibles begin to be inflated. Companies moved out of the market, etc. Well, fortunately, and I'll knock on wood, we haven't had any major catastrophes for quite some time. And there's a lot of opportunity in the coastal market, which companies have stayed away from. And as a whole, I would say that we are seeing more companies trying to capture that marketplace, which is great because it's just going to allow things to become more competitive, and it will give more options to clients. So that's a great thing. We are seeing in certain areas, and it depends on the company, but we are seeing, I would say, better storm wind deductibles that are available to clients. Some areas where we may not have had a palatable, when I say a palatable, perhaps a 3% wind deductible on a property in Virginia Beach. Some companies are opening it up where they're dropping it down to a 1. And in some cases, we're even seeing a flat deductible, which is great. So if you have an $800,000 house and you don't have a separate percent deductible, you can just base that off of your $1,000 deductible versus a 2% wind, which would have had a $16,000 deductible for an $800,000 house. So that's a huge advantage. So I think that's a positive thing. And then lastly, this is probably one of the hottest things that we have seen in the last couple of years is a change on coastal properties is the weekly rental exposures. A lot of people are putting their houses on VRBO, Airbnb, and previously there were not a lot of great markets for this. You'd had to put it in a non-admitted carrier that's not backed by the state, but companies are starting to open up to this a little bit. They're starting to underwrite more openly and even providing endorsements for this type of weekly rental, which is great because it's better coverage, it's more competitive. So I think that's a positive move going forward.
Hey Travis,
yes.
Sorry, I have some questions about the Airbnb and the VRBO properties. What's the difference between needing that extra insurance versus just kind of a blanket umbrella policy? What's the benefit of it? What kind of things are they covering?
So a lot of companies, if they're aware that you have a weekly rental exposure, they do not want to write it at all. So it's against their underwriting guidelines. It's against their policy language. So if, let's say you were written on a normal homeowners policy, you have a fire in your home while it's being rented by through Airbnb or whatever it may be, they're most likely going to deny the claim due to that exposure not being provided on the policy. So it is imperative, and people are typically very transparent when they're going to have a weekly rental that they're doing it, but it is imperative that you're put into a market that allows for that, and the policy language will respond to that.
Mm-hmm. Good to know. I run an Airbnb, and I don't think that there is a specific Airbnb insurance set on it right now.
Yes, you would definitely want to make sure I would definitely double check with your agent that they have you written as a weekly rental program.
Mm-hmm. All right, thank you.
Yep. So we're going to jump over to flood insurance, which as a realtor, I know can be a hot button. And there's a common misnomer. Somebody says, is this house in a flood zone? Well, theoretically, every house is in a flood zone. It's just whether or not it's in a high hazard zone. And more formally, you could say, is it within the 100-year flood zone? And that means it is in a high hazard zone. The non-high hazard is considered the 500-year flood zone. So I've listed what we see is most commonly on the coast is the most common flood zones that you'll see. A brief description: AE, damage from rising water; AO, damage from wave wash; and VE is the most severe zone, and that's damage from a wave wash that'll exceed, I think it's 3 feet during the 100-year event. So those are the 3 different zones, AE being the best out of that, VE being the worst. And I'm sure every one of you have seen all of these zones come up over the years. So, and typically FEMA will update their maps every 5 years. Now that doesn't mean that every area needs to be updated, but they will typically look at it every 5 years, and if they feel that the maps need to be updated, then they will update various areas. One caveat to this, which is important to have flood insurance with somebody that is knowledgeable in the field, is, and this is a terrible thing, but it's just the nature of the beast. If you are through a national flood insurance program carrier and you are re-rated, let's say from that AE zone to a VE zone, your policy is not typically updated, or your policy is updated because it got worse. They're going to charge you more. So they will re-rate your policy accordingly. Now, if your home is mapped from a VE to an AE, then they will not update your policy accordingly. So that's why it's important to have an agent that's keeping their hands on it, keeping an eye on things, because that can be a dramatic difference. I had clients in right around 2015, and they got moved from a VE to an AE, and it could be $4,000 or $5,000 a year in premium. So it's a major savings. So there, which I'm sure a lot of people have seen, and they hear about this, flood insurance premiums escalating dramatically from year to year. Where do we typically see that? It's in what we would call a pre-firm home. And a pre-firm home is a building which was built before a certain date. And that's when the flood insurance rate map became active in a community, and every community is different on date. But it's typically on or before 1974, but there's areas where communities didn't even get involved until the late 80s. So it could be that a home's eligible for pre-firm rating before that date. Pre-firm homes, which I would just say an older house, back in the day, and I'm going to say back in the day, 6-7 years ago, a pre-firm rated home might have been very cheap. But FEMA has been losing money on these properties, and they want to obtain the correct premium for the risk. So they have taken dramatic rate increase. And on secondary homes, you can see almost 25% increase a year, which is insane. And there are ways in which people can improve that potentially. And that's why it's important to contact your agent if you are being written that way, so you can get some advice. I have somebody that I worked with about 2 weeks ago, and they were written off a pre-firm rating, secondary home, and they were paying, I think, about $12,000 a year for their insurance. And based off the elevation certificate, now they'll be paying $2,000 a year. So we guided them. They were able to get a full refund for the previous year, or the current year, and moving forward, they'll have a much better premium. So that's a interesting piece that's often looked over. But so we can move over to grandfathered policies. The policy will say right on it if it's been grandfathered. It's as a real estate agent, as an insurance agent, which we don't get anything on a policy that's grandfathered. It's very important to maintain grandfathering. You never want to be moved outside of a grandfathered policy. And the only way, if you're going from a seller to a purchaser to maintain grandfathered coverage, it has to be assumed. And the only time that you can assume a policy and move it to a different company midterm is if it's a USAA policy, because not everybody's a member of USAA. So that is that's a very important thing, and it's great if you can obtain a grandfather policy. So what's new with flood insurance? the private market is just, I mean, it's changed everything as far as flood insurance is concerned. The only time that you can't typically use the private flood insurance market is if you are obtaining an FHA loan. But I think every other loan product allows for the private flood insurance market. And the private flood insurance market has changed a ton over the past few years. I think it was unrolled in Virginia 3 or 4 years ago, and it's become so much more sophisticated. I think you'll see that it's more consistent in pricing from year to year because of how sophisticated it's gotten. And two, there's a lot more insurance companies that have gotten involved with it, which is, supply and demand, more companies, more competitive. So it's great. That's been a wonderful improvement. A lot of times you don't need an elevation certificate. You can have a great insurance rate and a good insurance program. And so that's a new great thing that's been introduced. And I see somebody had a note here.
Yeah. Did you see the question pop up? How often do you suggest
Yep.
homeowners review policy for possible savings?
Yep, that's a great question. So I would say that it depends. I think it depends on your situation. When's the last time that you actually shopped your insurance? Who did you shop it with? What does your premiums look like at renewal? I'd be lying if I said it was common that your premiums go down every year. Just inflationary increases alone, they typically do increase. But I would say if you just bought a house a year ago and you did a good job shopping your insurance, I don't think you need to shop it the next year. Now, if you bought a house 3 or 4 years ago and your insurance has gone up by 20%, perhaps, then maybe it is time to shop your policy. But I think it's definitely a personal thing. One nice thing about Town Insurance is we are queued. Our service staff is queued to shop an account if it does incur an increase of a certain amount. So if it incurs a certain amount increase, and it depends on the policy line, then it goes into our service staff's queue to shop that account to make sure that company is still offering an honest, competitive rate.
And Travis, this is something that you would absolutely, you're more than happy to take somebody's policy and review it for them and let them know if they're in a good place or not.
Without a doubt. And we do that for our clients, every day. We're constantly shopping our clients' accounts and new individuals as well. It is a very easy process to shop your insurance, depending on how many different lines of insurance you have, but it's typically very simple.
Yeah, good. I just want to make sure that everybody knew that if they wanted it reviewed, that you guys would absolutely do that for them.
Absolutely. So I think we can move over to the flood insurance quick note. So I've got a couple examples that I'm going to be placing to you guys that will kind of show the difference of having not that I'm considering myself an expert, but somebody that's knowledgeable in the field review flood insurance. And I do want to introduce what the base flood elevation is, because it's going to be a very important topic for the next 2 slides. And long story short, the base flood elevation is the height in which the water is expected to rise during that 100-year flood event. And so that is all relevant. Not necessarily if you have a base flood elevation of 7 feet, that doesn't mean you have 7 feet of water in your yard. What that means is it will base it off the elevation certificate, so you know exactly what your exposures are and what options you have as an individual that lives in a flood zone. So if we bump over to the next slide, I'm going to give you an example. So this is This is a property that is out in the western part of the state that somebody referred to me. I write a lot of flood insurance, so I have a lot of contacts across the state of Virginia for primarily flood insurance, but we write a lot of homeowners insurance too. So this was somebody in the western part of the state that called me this week, and you'll see that what I try to do is I try to guide people on, give them every option that's available. So this person reached out to me, and the first thing that you'll see, it's in an A zone, which is more common out west. You don't typically see that on the coast, but it's in the 100-year flood zone. The base flood elevation is 709 feet. So what does that mean? Maybe nothing. But in this case, it means a lot, because if you look at the lowest adjacent grade around the house, which is the lowest adjacent, it's the lowest ground level, it's at 805 feet. So the lowest ground level is 15 feet higher than the 100-year flood zone. This house should not be in a flood zone. FEMA has incorrectly mapped it. So what this client will most likely be able to do is they will be able to file what's called a letter of map amendment, and FEMA will redraw the map for their property and move them out of the 100-year flood zone, relinquishing them of a requirement to have flood insurance. So for this person, even though they're well elevated, they had to pay $600 a year, and theoretically they should never need it. This is an example of how you're getting somewhat of a professional review, and how we were able to guide this client to not needing flood insurance most likely any further. So if we go to we're on it, good. And so this was just yesterday. This is perfect example of poor advice to somebody that lives in a flood zone. This is a property in Virginia Beach that we insure. It's in the AE zone, and it has a base flood elevation of 7 feet. The client was advised by a contractor, and it was a foundation company, on making changes to their home and foundation. They spent the money to install 11 smart vents, which are engineered flood vents, on the garage and crawl space. I was not aware that they were doing this project. We have them in a private program that's a quarter of the cost to the FEMA program that they had an option to have. And they called me yesterday with a lot of excitement for these changes that they made to their house. And unfortunately, you'll see that the C2A, which is the top of the bottom floor, that's the bottom of the crawl space for this home, that's at 3.0 feet, and the lowest adjacent grade is 3.7 feet. So what does that mean? That they have a subgrade crawl space. Their crawl space bottom is lower than the grade around the house. This house is not eligible for a venting credit. So this unfortunately did them no good. They installed these vents with the advice of somebody, and they shouldn't have. And so this is a shame. Now, my second note, I do need to rephrase that, where the base flood elevation is greater than so the house is at 6 feet is the first living floor. That's 1 feet below the 100-year flood zone. There is a slight discount on the policy if they had an above ground crawl space, not a subgrade. So there would be a small savings, and I ran some numbers for this specific client. As a subgrade crawl space through FEMA, their rate currently would have been $5,200 with their vents as if they were above grade. If they were above grade, which they're not, if they vented the home, they would still be 1 foot below the 100-year flood mark, and it would have saved them about $700 a year. So did want to fix that typo there. There is a little bit of a credit for venting, even if you're below, your first living space is below the 100-year floodplain. It's just not a lot. Now, let's say that this house, just as a quick note, let's say it's on a regular crawl space. First living floor was at 8.1 feet. They put flood vents in that were adequate. That would have dropped their premium to about $1,000 a year. So there are times where it makes a lot of sense to make these changes, but there's times where it doesn't as well. So unfortunate for this client. But again, that is what is important about having somebody that understands what they're looking at and how to digest this information. Unfortunately, and I've seen this, and I had a realtor that I worked with a couple years ago. They had an elevation certificate that was done by a licensed surveyor, and the licensed surveyor marked the house as being in an X zone. Now, theoretically, the property was higher, like in that first scenario I showed you. It was higher than the 100-year flood zone. The property was elevated outside of the 100-year flood zone, but FEMA still had it as being in the AE zone. The real estate agent advertised the house as being an X zone, not required to have flood insurance, and she got sued after the closing for advertising the house incorrectly. The client bought it with thinking they wouldn't have to have flood insurance, and there was, I guess, they wanted the house and there was no flood contingency in the contract. So that's we can look at an elevation certificate and flood maps, and we can guide you to make sure that you're presenting the appropriate information. But unfortunately, in most situations, the surveyor is accurate on what information they're providing, but there are times where there are errors. And we see that at times. All right, so let's jump over outside of boring flood insurance, and we'll talk about some of the potential impacts that we're going to see due to COVID-19. So in 2020, as a lot of people know, insurance companies gave back billions, hundreds of millions, depending on the carrier, back to their policyholders. In some situations, it might have been $40 a car. Sometimes it might have been $100 a family. It depended on the company, but they get back some money due to good loss ratios. Not as many people were driving. It was more of I would say it was probably more of a marketing aspect than anything. But anyhow, it was nice. So a lot of people worked from home in 2020. Less people were driving, less accidents on the road, less collisions, less glass being broken on a windshield, whatever it may be. So from a loss ratio on auto in Virginia, which in the last few years hasn't been great, it should be much better in 2020. And it's probably still doing better because a lot of people are still working from home. And also, property losses should be lower in Virginia. Some states got hit hard, like Texas last year, but as a whole for Virginia, property losses should be pretty good. No major catastrophes, and also, there's people were at home. So if you had a water pipe leak, you probably found it a lot quicker, than being away from your house for 12 hours a day or 10 hours a day, whatever it may be. So if something did happen, you were able to quickly mitigate that damage. So I think property losses as a whole should be lower as well. So I think that's good. Hopefully we'll see a flatter increase in 2021 and, versus if we had a bad loss year. I think moving forward, I think everybody would probably agree that there's definitely going to be a large increase of individuals that work from home, which should further mitigate losses moving on, and hopefully, that will help insurance rates. One thing I will note, which a lot of people think, everybody thinks they pay too much for their insurance, but Virginia actually is a very cheap state to have insurance for auto and home. We're probably one of the cheapest on the East Coast, so that is a benefit of being in Virginia. So. And other than that, that is pretty much everything that I have.